The Aussie tumbled sharply in Asia today in response to poor economic data from Australia and China. Australian retail sales unexpectedly dropped 0.8% month-on-month in July, compared to an expectation of a 0.2% month-on-month rise. Historically, that was the biggest fall since October 2010. In particular, sales in department stores dropped a steep 10.2%, the biggest fall in 7 years. Another piece of data also showed that job advertisements dropped 2.3% in August, the fifth consecutive month of decline, which indicates continuation of a softening in the job market. The TD Securities inflation report expectation jumped 0.6% month-on-month in August, much higher than the prior month's 0.2% month-on-month, but over the year, the gauge was at 2.2%, which is towards the lower end of the 2 to 3% target range. The Reserve Bank of Australia will announce the rate decision and is widely expected to keep rates unchanged at 3.5% for the third straight month. However, the odds of an additional rate cut is increasing and markets are fully pricing in a cut to 3.25% in November. Meanwhile, overnight indexed swaps suggest that there could be at least 2 more cuts in the next 12 months. Meanwhile, economic data from China is also pressuring the Aussie. The official PMI manufacturing data released on Saturday dropped to 49.2 in August, below 50 for the first time since November. The HSBC manufacturing PMI was finalized at 47.6, the lowest since March 2009, and stayed in contraction for 10 straight months. The data showed further deterioration in the outlook for Q3, and there are talks that China could indeed miss this year's growth target of 7.5%. A front-page article in the People's Daily urged the Chinese authority to, decisively, adjust its policies and should reverse prior tightening quicker to stimulate economies. Recent data did look worrying for the authorities and would likely trigger additional stimulus. But judging from the response in stocks, investors are not too convinced on any long-lasting effect yet. Other data released today saw New Zealand's terms of trade drop more than expected by 2.6% quarter-on-quarter in Q2. Japan's capital spending rose less than expected by 7.7% in Q2. Swiss retail sales and SVME PMI and Eurozone PMI manufacturing final figures will be released in the European session. But the major focus will be on the UK PMI manufacturing figures, which are expected to improve just slightly to 46.1 in August. Elsewhere, equities markets are relatively firm. The uplift in market sentiment indicated that investors very much welcomed Fed Chairman Ben Bernanke's speech at the Jackson Hole Symposium. While not signaling any particular action on any particular date, Bernanke's comments sent a strong signal that further quantitative easing is on the way. During his speech, Bernanke defended the use of unconventional easing as effective, with evidence that balance sheet expansion has supported the economic recovery. While evaluating costs and benefits of quantitative easing, the chairman stated that costs remained manageable and the Fed would not rule out the further use of such policies if economic conditions warranted. While the speech appeared to have pushed the timing of QE3 closer, we think the likely timing will be in either September or December, instead of October as the election approaches. In Europe, markets are eagerly awaiting the European Central Bank's rate decision later this week and are expecting Draghi to unveil the details of the new bond buying program. According to sources, Draghi is finalizing the proposal and would send a list of options to executive board members tomorrow. The options could include yield caps, limits on spreads over bonds and purchases of a range of assets in addition to sovereign bonds. At this point, no single option has emerged as the preferable solution thus far. Based on the current situation, some economists are readjusting their expectations and thought Draghi couldn't reveal any details and could remain vague after this week's ECB meeting. But at least, all are expecting Draghi to be clear that works are in progress, in what direction, and to give a certain time frame. Aussie dollar, US dollar daily outlook had dropped further to as low as 1.0239 so far today, and intraday bias remains on the downside to the 1.0176 support. a break there will target 0.9968 and below. Nonetheless, as a fall from 1.0612 is viewed as a leg inside the medium-term consolidation pattern, we'd expect support below 0.9968 to bring a rebound. Meanwhile, a break of the 1.0410 resistance is needed to signal a completion of the fall from 1.0612. Otherwise, we'll stay bearish even in the case of a recovery. In the bigger picture, price actions from the 1.1079 high are treated as a consolidation pattern in the larger uptrend in the form of a triangle. A fall from 1.0612 could be the fifth and final leg in this pattern. Hence, such a decline from 1.0612 is expected to extend further lower ahead to the 0.9968 support and below. And the downside is eventually expected to be contained above the 0.9588 key support. After that, we might see an upside breakout from new high above 1.1079 after the consolidation completes.